Welcome to the Deep Dive. Today we're really digging into the economic pulse of Addis Abeba and Ethiopia more broadly. We've got a stack of recent reports here.
Yeah, quite a mix. Everything from city development to avocados, believe it or not.
Exactly. So think of this as your guide to what's actually happening on the ground. We're looking at urban redevelopment, these big avocado ambitions, tax issues, the car industry's new direction, digital parking.
The rise of a new bank, the human side of displacement, aid dependence, and how those industrial parks are doing.
Right. Our mission for you. To pull out the key insights, connect the dots between these, well, seemingly separate areas, we want to give you a clear picture of the economic trends, the hurdles.
You can really get beyond just the surface stuff. We're aiming to uncover the underlying dynamics, what it all might mean.
Okay, let's jump right in. Addis Abeba's urban redevelopment. These riverside and corridor projects, they sound ambitious, a modern vision.
They certainly are. But the reports paint a really complex picture, especially for the people being moved. Longtime residents shifted from public housing to these new condos. It's a huge change.
A massive upheaval. And the financial side seems problematic. People are being relocated, yes, but then they're facing these hefty down payments for the new condos.
That's a critical point. We're talking around 120,000 birr for a down payment.
Which sounds like a lot, especially when you compare it to the compensation they're getting, which is more like
around 85,000 birr, typically. So right away, there's a shortfall, a big one.
It almost sounds like the move itself is designed to put people into debt from the start.
Well, it seems that way for many. And adding to that, there's this issue of promises versus reality. Many residents apparently expected affordable public housing alternatives.
Options that just didn't materialize for a lot of them.
Exactly. So without those alternatives, they're kind of nudged toward buying these condos, even if they're financially stretched. Makes you wonder about the initial planning, the consultation.
And the consequences are hitting hard already. Over 4,000 households are reportedly struggling with debt, maybe even facing eviction as deadlines loom.
It's not just numbers. We have these personal stories, like Siri Habiru mentioned in one report, facing potential homelessness with her kids over this 120,000 birr prepayment. It really brings the human impact home, doesn't it?
It absolutely does. And you hear from others, like Yiparekse Guy and Dawit Cabresis, about these unexpected costs, using their compensation just to make the new places livable because maybe they're not fully finished.
Right. So beyond the down payment, there are these hidden costs piling up. It raises that fundamental question, are we balancing modernization with the well-being of the people who've lived there for years?
It's not just residents feeling the pinch either. The Commercial Bank of Ethiopia, CBE, seems to be in a tough spot too.
How so?
Well, recovering the money from these housing projects, the report mentions they've only gotten back about 1.9% of the, get this, 25.85 billion birr owed from housing bond repayments.
Wow, 1.9%? That's incredibly low. That points to some serious financial risk, surely.
You'd think so. It makes you question the whole financial model behind these developments, doesn't it? And what the knock-on effects might be for CBE, maybe even government finances.
Definitely. And the scale keeps growing. The first phase was big, impacting thousands. But phase 2, even bigger, 132 kilometers.
That's huge. And there's this deadline coming up, June 7th, 2025. For residents to sign the sales documents. The pressure must be immense.
It seems so. And apparently, letting people move in before paying everything off, while maybe well-intentioned, has created this backlog of unpaid amounts.
Plus, the legal side sounds a bit precarious for residents, too.
Yeah, legal experts point out the housing corporation still technically owns the properties until those contracts are signed. So people are living there, but their legal standing isn't fully secure.
So it boils down to this tension. Modernization drive versus the social and financial reality for long-term residents. Could there have been a different way?
That's the million-dollar question, isn't it? Now, shifting gears completely, avocados. Ethiopia has some seriously ambitious plans here.
Avocados? Okay, tell me more.
They're forecasting production of 18.1 million tons, which is just astronomical.
18.1 million tons compared to what they actually exported last year.
Less than 1 ton was exported last year.
Okay, wait. Less than 1 ton exported last year, and now they're talking millions. That's quite a leap.
It's a massive leap. The strategy is to split this huge forecast, 50% for export, 40% domestic, 10% industrial use. But that export target alone, jumping from, 781 kilos last year to a planned 10,000 tons.
That sounds like it requires a completely different level of infrastructure, logistics,
Yeah.
everything.
You hit the nail on the head. That's the big concern highlighted in the reports. Is there a disconnect between this grand vision and what's actually possible right now? Logistical bottlenecks, capacity issues, inefficiencies in the whole value chain.
And it's not just about quantity, right? It's a type of avocado.
Exactly. Apparently, only one of the 7 varieties they grow is easily exported. Foreign buyers really want specific types, especially the Hass avocado.
Which isn't widely grown yet by most farmers there.
Not in large quantities, no. Though there are efforts, U.S. Society, Israel's Mershav, either promoting Hass and seeing some good results with the farmers they work with. But scaling that up is the challenge.
And then there's what happens after the avocado is picked. Post-harvest handling is mentioned as a weak link, leading to quality loss.
A critical weak link, yes. A lot of potential is lost right there. Experts say many farmers just don't have the know-how or resources for proper handling, storage, cooling.
So you need education, investment in cold storage,
right,
better transport, the whole 9 yards.
Pretty much. The government's trying things like cultivation clusters, free seedlings, subsidized tests, which sounds good.
What?
But farmers report issues even there. Expensive seedlings sometimes, heavy water needs, not enough variety choice. So practical hurdles remain.
And transport issues, too. Rough handling by intermediaries.
Yeah, mixing ripe and unripe fruit causing damage. And the big one, a real scarcity of refrigerated transport. That's crucial for export quality.
Still, there have been some successful pilot exports to Europe, to Rotterdam.
Yes, which is positive. It shows the market is there, despite delays getting refrigerated containers, if they can crack the logistics.
But exporters face risks, too. Getting paid, dealing with dodgy buyers.
That's a major deterrent mentioned. Not getting paid, getting less than agreed, trying to track down unreliable buyers overseas. It's risky business.
But the potential payoff is huge, right? Mm-hmm. Global demand is strong. Ethiopia's climate allows multiple harvests.
Absolutely. If they can nail down the key things, better roads, cold storage, trustworthy partners, better handling it could be a massive source of foreign currency. But it's a big if.
Okay, from potential export booms to a more persistent headache, government revenue, tax collection is up, but maybe not enough.
That seems to be the story. They collected 653.2 billion birr in the third quarter, which actually beat the target for that specific period.
Okay, that sounds good.
But compared to the annual spending target of over 1.2 trillion birr, it shows how big the gap still is, even though that quarterly figure was a 74.5% jump from last year.
And inflation and the weak birr are eating away at the real value of that money anyway.
Exactly. Plus, you've got the huge informal economy, which is always a barrier to boosting the tax to GDP ratio. That's a tough nut to crack.
And smuggling seems rampant. Customs sees 15 billion birr in contraband, a 32% increase.
Yeah, and caught smuggling is a massive issue. It's seriously hurting official export revenues. Only $28.3 million earned from caught recently, a 35% drop.
And the report suggests most of it is smuggled. Like, less than 10% goes through official channels.
That's the estimate. It means legitimate exporters are getting undercut on price and losing huge volumes of business.
Are the efforts to fix it, like relicensing exporters or setting up a trade center in Ade, making much difference?
It seems marginal so far. The Customs Commissioner acknowledges the long-standing problem. The Ade Center is an attempt, but enforcement and tackling the price differences with neighbors are key.
Then there's outright tax evasion, fake receipts, online transaction dodging, under-invoicing imports.
The under-invoicing figure is shocking. 85% of imported goods reportedly declared below their real value. Plus concerns about illegal checkpoints, weak oversight in mining, and gaps in digital tax collection, too.
It sounds like a multi-front battle, and maybe taxpayers aren't always aware of their obligations. Or maybe they resist new systems.
Both seem to be factors. Limited awareness affects profit tax and VAT collection. There's pushback on the new market-based VAT system from some businesses.
And putting VAT on farm inputs. Yeah. That's controversial, isn't it? Could worsen food inflation.
That's the criticism, yeah. It all adds up. As MPs pointed out, current tax revenues only cover about half of federal spending.
So even with nominal increases, the birr's depreciation means purchasing power is way down.
Right. And some experts link this tax avoidance to, well, maybe a lack of public trust or transparency in how government money is spent. That's a deeper issue.
Okay, let's shift to the automotive industry. There's a big policy draft aiming to make Ethiopia an assembly hub.
A very bold strategy. Lots of incentives planned, especially for electric, hydrogen, and LPG vehicles.
And cracking down on used car imports, plus a new loan scheme.
Yeah, and tax breaks for EV charging gear, plans for battery disposal. They're thinking about the ecosystem. But also, tariffs on fully built imported cars are going up even more, another 20% excise duty.
Trying to really protect that local assembly market.
Clearly. Stricter quality rules, too, banning salvaged cars, requiring OEM certificates, microdot marking for tracking. And they want to steer assemblers into industrial zones, maybe even a dedicated auto park.
But the production target sounds steep. 5,000 units per plant per year to get incentives.
It is demanding, especially given where things are now. Current capacity, particularly for EVs, is massively underused. Less than 10% of the potential 84,000 unit EV capacity is actually being used.
So imports are still dominant, especially for EVs.
Very much so. The government's trying to nudge its own departments to buy local EVs with a 15% price preference in tenders, but it's a start.
But implementation is lagging, and assemblers are protesting higher duties on the kits they need to import.
Yeah, it seems like there's friction. The association says raising duties on CKD-SKD kits undermines the goal of boosting local assembly. Plus, falling purchasing power makes higher-priced local cars a tough sell. Plant usage has dropped sharply recently.
And unpredictable tax changes create uncertainty for everyone, right? Investors, buyers.
Absolutely. And there are worries some firms might be gaming the system, getting assembler licenses just to import fully built cars more cheaply. Needs tight regulation.
So the policy aims high, even looking at exports within Africa eventually, but success depends on actually doing all the support stuff, battery disposal, scrappage programs.
And on banks having the liquidity to finance it all, which is still a background concern.
Okay, let's zoom back into Addis. Cashless parking. Sounds like a move towards digitization.
It is. A new mobile app platform for parking lots across the city. The main goals: get rid of cash handling, reduce potential corruption, and boost revenue.
How does it work, basically?
Drivers register their car, use the app to clock in and out. Fees, currently 20 bursts per half hour, are calculated automatically. Payment is only through CBE for now.
Only CBE, and there are load fees.
Yep, 5% daily interest after a 24-hour grace period. The traffic authority thinks it'll save money on printing receipts and maybe double or triple parking revenue.
And traffic officers are getting tablets for e-tickets.
Over 600 of them. It's all part of standardizing fees, though prices might vary by location eventually. Existing parking associations are involved too, getting training and smartphones.
It fits with the bigger national digital payments push then.
Exactly. For now, cars registered outside Addis can pay cash once, then need to register. But compliance and payment reporting are reportedly improving already.
Analysts think it'll cut down on dodgy practices through automation.
That's the hope. Centralized systems, less cash changing hands. But that CBE-only payment thing, that's raised eyebrows. Could be inconvenient.
Yeah, people might want more options than just one bank.
You'd think so. Maybe that will come later. But standard, transparent pricing is a big plus. Should reduce arguments over arbitrary rates.
And getting rid of unofficial attendance, marking spaces clearly, sounds more organized. Plus, planning EV chargers in parking spots is looking ahead.
Definitely. They're also planning to phase out street parking on busy roads, with a hefty fine if you ignore it.
But challenges remain. Right.
Yeah.
Setup costs, tech glitches, getting everyone used to it, needing reliable internet.
All potential hurdles. Reliable connectivity is key, and ensuring a smooth transition for users and the operators themselves.
Okay, now on to banking. CNAG Bank. They showed some pretty impressive growth, haven't they?
Remarkable growth, yeah. Net profit up nearly 83%, deposits soaring, even overtaking a competitor like Citibank in deposit mobilization.
But they're hitting a ceiling on lending because of central bank rules.
Exactly. The national bank's credit growth cap is limiting their lending, so they're active in the interbank market, buying government securities to manage their funds.
But it means their loans haven't grown as fast as their deposits. Lower loan-to-deposit ratio than average.
Right. Which suggests they might have idle resources, money not being lent out. While their assets have ballooned and they have a big branch network, this imbalance could affect profitability down the line.
A lot of their new loans went to agriculture, though, which fits their background.
Yeah, about 38%, sticking to their roots as a microfinance institution. But even with strong profit growth overall, key metrics like return on equity and assets are still behind the industry leaders.
So the profit jump is maybe more about getting bigger than being super efficient.
That seems to be the analysis. More leverage than pure operational efficiency. And high staff and admin costs are a big chunk of expenses. Could be a vulnerability if revenue growth slows.
Mm-hmm.
Profit per employee is also kind of modest.
And there were some other flags. Impairment losses, a qualified audit opinion.
Yes, impairment losses on non-loan assets surged. which could hint at balance sheet risks. And the qualified audit opinion related to unresolved IT migration issues raises questions about internal controls. They're still shaking off that microfinance baggage, as they call it.
But deposit growth is strong, international banking is growing, they've secured government accounts. There's positive momentum, too.
Definitely. They're investing in buildings, digital banking adoption is rapid, they plan an investment bank, entering the capital market. Ambitious stuff.
But they need to diversify lending, improve transparency, boost efficiency to keep the growth going.
That seems to be the prescription, balancing growth with strengthening the fundamentals.
Let's talk about aid dependence now, a really critical topic for Ethiopia. There's a new bill to streamline emergency response, create a national disaster fund.
And the framing is interesting. Preserving dignity, independence, and sovereignty seems linked to past aid disruptions.
Like the U.S. aid suspension in 2025. That had real consequences, didn't it?
Swift and brutal consequences, according to the report. Cholera outbreaks, water shortages, healthcare layoffs, interrupted HIV treatments. It showed just how vulnerable things were.
NGOs had to stop work. Early warning systems went down.
It was a stark reminder of how unpredictable and, frankly, political foreign aid can be, highlighted the risks of relying too heavily on it.
So this new bill aims for more self-reliance. A national fund with 17 finance sources earmarking 3% of the federal budget.
That's the plan. Though some question if a new bureaucracy is needed versus strengthening the existing Disaster Risk Management Commission, the DRMC.
Which already struggles with funding. Reserves get emptied quickly by droughts.
Historically, yes. Severe droughts drain resources fast. Parliamentary budgets for disasters often get exceeded. Donor appeals help, but often lag behind the need.
And these repeated shocks hurt the economy overall, diverting funds from development.
Right. Donors still cover most relief costs, but the timing isn't always ideal. The Productive Safety Net Program, PSNP, is better for timely drought response, but it's also heavily donor funded.
And climate change is expected to make things worse, potentially. More droughts.
That's the projection, yes. Which makes domestic funding even more critical, especially as donor pledges were trimmed recently due to other global crises.
So the government wants to boost domestic funding, but technical capacity, early warning, logistics also needs work.
Absolutely. Funds are one thing, deploying them effectively is another. The government strategy mentions things like insurance, World Bank credit for bigger shocks.
But concrete steps are needed now. Plugging budget leaks, capitalizing that reserve fund, maybe using insurance linked to PSNP, engaging the diaspora.
Those are the kinds of urgent actions proposed, because relying solely on uncertain aid just isn't sustainable for building long-term resilience. Domestic financing has to be central.
Finally, let's look at the industrial parks. They were meant to be a big driver of export-led growth, but they're facing challenges.
Significant challenges, it seems. High worker turnover is a big one, more people leaving than being hired. That's disruptive.
And export revenues are slumping, way below target, partly due to losing AGO access to the U.S.
Yes, the suspension of AGOA, the duty-free access, hit hard, especially for apparel and footwear exports. Studies show a definite drop.
And the Industrial Parks Development Corporation, the IPDC, is struggling financially, tenants not paying rent.
That's a major issue. Revenue and profit are below projections because rent isn't coming in reliably, makes it hard for the IPDC to operate.
But investment in the parks is still okay, attracting new capital, even domestic investors.
That's a relative bright spot, yes. More domestic money flowing in could be important for the future.
What about import substitution efforts? Trying to make things locally instead of importing.
Facing hurdles there, too. Quality issues, competition from cheaper imports, especially in textiles. Calls for longer tax breaks, better logistics to help local firms scale up.
And output is even slipping in some established parts, like Hawassa. Some tenants complain about high taxes versus cheap imports.
That's reported, yes. And concerns about low capacity use in some factories. Plus, a suspicion that some investors are just there for the cheap infrastructure, not really to build a strong industrial base.
And the IPDC's income is too reliant on rent. Land acquisition for expansion is slow. Standoffs with residents.
All contributing factors. Land acquisition is a major bottleneck. Title deeds are held for only a fraction of the planned land. Disputes are stalling investment in places like Bolelemi.
Plus unexpected costs like extra security due to unrest on trade routes.
Squeezing margins further. So as Ethiopia looks towards maybe joining the WTO, urgent reforms seem needed to make these parks, and the businesses in them, truly competitive.
So wrapping this all up, this deep dive reveals a really complex picture, doesn't it? Ambitious plan, running into some very real hurdles.
Absolutely. Financial, practical, social hurdles across the board.
And what stands out is how interconnected it all is. Urban displacement impacts finances. Trade volatility affects industrial parks. Aid uncertainty drives the need for domestic revenue.
Exactly. These aren't isolated issues. They're all threads in Ethiopia's development story, highlighting this constant balancing act.
Which brings us to our final thought for you, our listener. As Ethiopia pushes for modernization, for economic growth, the big question that keeps coming up is this. How can these ambitions be balanced? Balanced with the needs, the well-being of ordinary citizens? And how can they build economic structures that are genuinely sustainable, resilient, less vulnerable to shocks both external and internal?
It's about the trade-offs, isn't it? And the long-term impact of the choices being made right now, something to definitely think about.
Thanks for joining us for this deep dive.